Bitcoin had a rough week, peaking around $108,000, going as low as $92,000, then closing near $95,000. A lot of this was a response to Jerome Powell and the Fed and all the things happening in the macro, leading many to believe that there's more pain ahead for Bitcoin, even though even the most bearish people on Bitcoin tend to think there's more pain ahead before it skyrockets up to $125,000 or $150,000. We're going to break it all down as we wrap up the year here on Macro Monday. I'm going to be skiing next week, so this will be the last Macro Monday of 2024. Can't wait to dig in with Mike, James, and Dave, the all-star crew. Let's go.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of All Streets. Before we get started, please subscribe to the channel, hit that like button, but especially hit that like button for these three gentlemen who show up even on holiday weeks, day in, day out, to provide you with the most amazing content. It's a good time to thank you guys for yet another great year on Macro Monday. We've been at this for a while, and I think Dave got the real Christmas present that came early, or Hanukkah present, or New Year's, or Kwanzaa, or whatever holiday we may be celebrating at the moment. You have officially announced your semi-retirement from CoinRoutes and have put in your application to work at the Department of Government Efficiency.
Yep. Well, no, I'm more or less, yeah. I mean, I'm out of CoinRoutes except as a strategic advisor as and when. And, you know, look, the company's doing great, and I am still very much bullish on its prospects, especially in this environment. But you know, it's time to pass the torch, and you know, Ian Weisberger, my son, who was his idea, and we ran it together. He has been running it and expanding it and building it, and you know, God bless, Godspeed, and let him do it. And I will, you know, I'm taking some time off, chilling, trying to decide whether I want to, you know, what do I want to do. I'm having some very preliminary conversations, but what I really want to do now that I have the time and financial flexibility is to help fix our completely effed up government regulatory framework, particularly for our industry and the financial industry writ large. And so the idea of helping and working with incoming Chair Paul Atkins in particular, and you know, potentially with the CFTC, is very appealing to me, because these guys need to understand, and there's the understanding of how the digital markets have evolved, what that means for traditional markets, and how convergence could be managed, all while getting rid of ridiculous amounts of inefficiency in those organizations, because they do things the same way now than they did 50 years ago, is incredibly appealing to me. And frankly, you know, I think I would be able to add value. So this is my attempt, believe it or not, to give back in a way. I know people will be all sorts of, you know, have all sorts of feelings about this, but my opinion is best to try to reform from the inside than to, you know, just dismiss and say, oh my God, they're a bunch of evil blah-de-blahs.
Would there be anything more epic than Dave Weisberger sitting in meetings with the Department of Government Efficiency and then reporting back on Macro Monday, assuming that you wouldn't quit on us? Because, you know, I've seen David Sachs is now the crypto and AI czar, and has been conspicuously missing apparently from the All In podcast for a month. So
yeah, you know, I suspect that the 6-month commitment in being in DC will be all consuming, and you guys would have to miss me for 6 months. But you know, we'll see. Certainly I would do it if I could. You know, it's a question of what it is. I mean, Elon is enough of a free speech maximalist that maybe he'd think it's okay, and that's fine. But you know, the thing that's interesting, I want to point out one news story from last week, which I think, which has not really been it has not gotten a lot of coverage, but that was the SEC finally doing a lawsuit that I think makes sense. And that was against Jump Trading for manipulation, you know, in part of the Luna. I don't know if you saw that, but you know, of all the lawsuits the SEC has launched, here they end up with a settlement with Jump Trading for market manipulation, which we all know. I mean, whether they did it or not, I mean, I'm assuming that's between them and the SEC. But the fact that somebody or firms can be part of a manipulation scheme, which ultimately cost investors what the collapse of the Terra Luna ecosystem cost, is very, very major. And it also tells you something that is really important. It tells you that Gensler, instead of going for jurisdiction and wasting $400+ million of companies defending what's a security could have been prosecuting fraud with regard to the way that companies trade crypto. Just think about that for a second. It means that 4 years of time, he could have been going after rug pulls and things that actually hurt investors, but instead he did not.
What's crazy about this story, though, Dave?
I find that just mind blowing.
Just to point out what was crazy about this story, and I actually didn't intend to bring it up because it also passed in my mind, but I did read that Bloomberg article when it came out 3 days ago, and the manipulation that they actually paid the fine for was for propping up the market. A lot of people thought that somebody would pay for crashing Luna intentionally, but what they actually did was mislead investors to believe that the algorithmic stablecoin was working by propping it up and buying to keep the peg. So it was a really, really interesting story because it was not the kind of manipulation I think that most people believed had happened. So a pretty wild story there. So, and Mike, I know you're traveling right now. We can tell. I like to say you're in Bill Barheit's living room because that's his favorite background. Dave working with his son, like before we dive in, like you and I were just talking about how the greatest thing is being able to actually spend a holiday with your families and take a little time off. Is there a greater legacy than leaving a company to your kid? I mean, come on.
So that's what I want. I'm glad we started there. Hats off to Dave, because I think Teddy Roosevelt said it, when you point out problems without pointing out solutions, it's just complaining. And Dave's very good at pointing out problems, and he's working on solutions. So Dave, to me, you're an example of what makes America great. You do well in the private sector, and then you try to help out, make it better. And that's what's happening now with this administration. You know, as much as us didn't like the morality of our new president, we have to go with the economics and go with it. And thank you, Dave. This is an awesome thing. I hope you find a lot of that graft.
I hope I get in. I mean, you know, who knows? I mean, it'd be nice to get, you know, more groundswell or ground roots support, but you know, a lot of there's some, I can't give up. I can't disclose some of the big names. There are a lot of people out there who have similar views to and in support of the mission of this administration, particularly in terms of Elon and Vivek. I've never talked to Elon, so I don't know him at all, but I have talked with Vivek, and I have a pretty good idea of what he wants to try to accomplish, and I'm very much in alignment. So, look, I hope for the opportunity. If it happens, great. If not, so be it. And, you know, we'll move on. But to me, the notion of smart people, and I mean like top smart, experienced people, blank sheet of paper going into 600 federal agencies and trying to rework them, if done correctly, could be a force multiplier for the economy. It would make everybody bullish if you really understood what that meant. The only thing that it does mean, however, is that the use of regulations writ large across every industry as a barrier or competitive moat to exclude smaller companies and innovators would be coming to an end, which is not great necessarily for the largest companies, although some will do extremely well in that environment. But it is great for Americans. And so we'll see how it goes. But you've all heard me talk about regulation and how important intelligent deregulation is. And that's why I thought it was really important to start with the jump trading thing, because I'm not picking on jump, but having a regulator that keeps the playing field level, that prosecutes fraud, that holds people to what they say they're supposed to do and do, is extremely important. Having a regulator that goes off the rails, that causes every company to have to spend 20 to 30% more than their regular operating budget in order to, quote, do compliance, which is really a code word for keeping, you know, bullshit happy, is a very different thing. And it makes innovation very hard. It's a hidden tax, and it's not even all that hidden. Anyone who's run a company can tell you the decisions you make are often, I mean, at CoinRoutes, for example, we made all sorts of decisions to avoid businesses because we know that we would have had to raise an extra $20-30 million, which would have, you know, significantly more than we had raised just to deal with the SEC. And that's just insane. So we never did those businesses. And that is a true statement throughout all of crypto. It's true in cannabis in terms of even companies that are having nothing to do with getting people high, but trying to use it for molecules for therapeutics. It is true across so many industries; it's almost impossible to understand. So yes, I know I'm off the tracks. I'm done. Sorry.
So let's focus on. I'm going to shift over to predictions for 2024. No risk in 2025. No risk in that. That's what we do. That's what strategists do. We throw it down on the line and get people tell us we're idiots for being wrong, and I've been wrong in a lot of places. So here's what I think is going to happen. We have this new administration come in. Markets way overpriced for the optimism of the long term. It's going to deal with the realism of the short term. We're going to see pretty significant cuts right away. We're going to see pretty significant tariffs right away. These are all based on what we've seen happening, certainly from the book No Trade is Free by Robert Lighthizer. And we all know what's happened. Trump knew about the mistakes of his last administration. He trusted the Chinese. They screwed him over with all those deals. Just throw off tariffs right away. Say, sorry, guys, you got to deal with it. And the thing is that really struck me about reading that book, No Trade is Free. It brought back things I talked about with clients decades ago. And when I was running some money at a hedge fund, is everybody in the world wants free trade as long as you can have a trade surplus with the U.S. That's over. Sorry, everybody who sells anything to the U.S. has an inordinate privilege of selling to the world's deepest, strongest demand pull market on the planet, bar none. We don't have that. There's no place even close to our market. So to me, that's what's going to shift. That's what Trump's going to fix. That's what but it's going to be short-term pain. So the key thing I have to point out is we haven't had a 10% correction in the S&P 500 since Q4 2023. So we're going to get that. First prediction, we are going to get a 10% correction in S&P 500 this year. When it does, Bitcoin probably should drop 30%. Maybe it won't. That would be awesome. But the question is from what level? And at the same time, you see bond yields ticking up. That's a big sign that we're getting that correction soon, because that's a bad sign. So overall, I think we're going to see the Band-Aid ripped off from this new government, get through it as soon as possible, get to the midterms, and make it happen. So overall, my key predictions are, the key thing I'm concerned about is this. I'll show it out, what's already pointing to that direction I'm pointing out is Bitcoin to gold ratio. It popped up to 40 gold ounces of gold per Bitcoin. Now it's down at 36. It's right at that high from 2021. And I love when Dave and I have pushed back on that. It's perfect. We need to disagree. If we don't add value to our audience. To me, that's already a sign of a big, decent peak. I'm afraid it's going to just be a normal peak and get bound to around 25, where it was right before the election. It's just things like that I'm concerned about. Another thing is a key fact I want to point out is I went back and read all my outlooks from the beginning of the end for 2024, and my focus was on the Great Reset. Now, I missed that in the States, but it's happening in the rest of the world. So one key fact I want to point out was this morning, 1.71. That's the yield on the 10-year note yield in China. China is in a severe deflationary recession, and they're exporting that deflation to the rest of the world. So this is another area we've had pushback. I think that the setup right now is for severe deflation. You only get that on the back of massive inflation. So let's talk with some numbers. 1.71, that's a yield on the Chinese 10-year versus 450 or so in the US. Another key fact is I only go back about 10 years on this data. If you look at the average 10-year yields on the top 5 other countries in the world in terms of GDP, starting with China to India, and then, of course, Japan, UK, and Germany in between. Right now, that's spread. Their yields are 127 basis points less than the US. That's the highest ever in 20 years. If you go back to right before 2008, it was the opposite. They were about 120 basis points above the US. So that's how high yields are in the US. That's how high risk assets are in the US. And another thing I want to point is $13 trillion. That's the amount that we added to market capitalization, total stock market capitalization this year. It's almost 50% of GDP. So to get inflation to go down in an environment where you're massively boosting the stock market on the back of excessive debt to deficit spending, which will tee off James, and at the same time we have this big pump up in liquidity and assets values and cryptos, is, inflation is not going to go down in that environment. To me, that's the thing I'm still thinking about for the deflation to kick in, is when we get that 10% correction. That's $6 trillion. That's 20% of GDP. It's going to happen. It's not going to matter. But so then I'll tilt over and I'll point out to cryptos. Look at what's happening in Ethereum. Ethereum's been giving us great technical indicators. Pumped up to around 4,000. It's down almost, 15%? It's nothing to stop to go to 2,000. So I'll end with this factor. I'm still big picture macro. I completely agree with the definable diminishing supply of Bitcoin, increasing demand and adoption. Price must go up over time. but it's just got too expensive around 100,000. To me, it's hard to get a better year than last year in terms of pumping up crypto assets. And now we have this problem I have with all cryptos. I've had it forever. There's an unlimited supply of cryptos. We have things we talked about, Fartcoin and Dogecoin and Shiba Inu. They're just way too speculative, expensive. They're starting to tick down now. I think that's the whole space where the people are realizing that, okay, we've priced in nothing but complete optimism. We have the stock market at the 95th to 97th percentile of expensive in history, according to all markets. This might be a bit of a problem for risk assets. And that's why I think we're going to get that correction next year and let's see how we come out of it. But it's going to be a great trading environment. It'll be a great environment probably to lay in some Bitcoin at a discount versus right now, a pretty significant premium and risk assets. And that's where I think we're heading for next year is we're going to get that back up. We're going to get a great chance for traders, a great chance for people to lay into risk assets at a bit of a discount rather than a premium. And the problem is right now, markets are priced for perfection. And I think we're due for one of those issues. I'll end with where I started, that Bitcoin to gold ratio at 36 ounces of Bitcoin to gold. It looks like it peaked around 40. It could easily go to 25.
Yeah, it actually has broken down below that all-time high that it had temporarily broken from 2021, as you can see in the chart. There's interesting something you kind of talked about there, Mike, that I've been thinking about. James, jump to you. Wouldn't it make a lot of sense with the Department of Government Efficiency, which we've talked about, obviously is going to disrupt things, short-term pain, long-term gain, as you said, wouldn't it make sense either for them to sort of cheer on a market correction now before the election, so they're starting from a lower floor, or to just get it over with at the beginning, because by the time there's a midterm election in 2 years, they'll have had their correction, whether we call it a recession, a 10% drop, whatever it is, and then they can come out of it and people will have forgotten. Isn't now, in the next 6 months, the time, if they were ever going to allow that floor to drop, James, for that to happen?
You would think so. But remember, Trump's ego is wrapped around the stock market. He doesn't want it to go down at all. You know that. We know that. So, we're stepping into a situation where they're talking about the Department of Government Efficiency and they want to cut expenses. But we've talked about it before. The reality is that there's $5 trillion of expenses that they can't cut unless they're going to cut massive number of workers and somehow make Social Security, Medicare, Medicaid more efficient to cut down the expenses from 4.1 trillion to what? 3.5? Like, you got to take out $500 million of expenses there, at least, if you're going to get anything done. But I'm not sure how they would even do that. We do know there's a massive amount of waste in DC, and the administration of all of those programs is probably way over, like far too expensive. But you've got that. You've got a $900 billion of net interest expenses. Like, where are they going to cut to get us into to get us out of deficit and into surplus? The only way
there's one way. There's only one way. And let's be clear about this. They're not hiding it. Vivek actually spoke last week or the week before and basically made this point, made a little bit more obliquely than I'm about to make it overtly. But the cutting expenses, yeah, that's a nice thing. So from a discretionary point of view, but you're right. Without entitlement reform, it's literally what James is talking about, just for the viewers, is if you look at the deficit, the biggest contributors, the biggest pieces are three things: entitlements, interest rate, interest on the existing debt, which is already there, and defense. Those are the three biggest things. And while maybe we can get some savings in the Defense Department, and I would like to think that that's possible, it's still not enough. What is enough is if you have to have hyper growth. You need 5+% real GDP growth. And the point is, get the government out of the way. People forget their dusty old economics textbooks, which used to teach, because it's true, that every dollar of government spent crowds out somewhere between more than one dollar of private investment. I personally think we're at every dollar of government spent probably crowds out $2 or $3 of government investment, which is a crazy multiplier. But if you understand just how bloated the bureaucracy is, you understand that's probably possible. So that is the point here. The point here isn't just to cut expense. The point is to free up private innovation, put money back into the private sector, because there's tons of money out there to invest.
Right.
The issue is, in many cases, it's just not economically viable to do so. And that's why you get during bubbles, Silicon Valley pushing valuations up to crazy levels, and Wall Street types scratching their head saying, how the hell do you come to that? And I understand the difference. And you look at various crypto projects and other things, you see this. The issue is just freeing up the economy. But I want to go back to something Mike said, because it's exceedingly important to understand that yes, the stock market is overvalued. And yes, we have the highest wealth inequality ratio that we have ever had. And yes, the US rates are higher than the rest of the world, despite being a better credit risk, arguably. All of those things are true. But it could all be described under the umbrella of one word, which is not going to change in this administration or any administration until we end up with something far different, and that's financialization. We live in a world where the governments, both parties, all parties, and you more or less have to, I mean, I've talked about this before, want asset inflation and use that to prioritize capital over labor in order to suppress consumer inflation. The one interesting thing about this administration is J.D. Vance is well aware of what I just said to be true. Now, I haven't talked to him, so I don't know this, but his speeches indicate that he understands this. His book indicates that he understands this, which tells me that that is the one wild card when valuing assets. If you take to a logical conclusion what he thinks is true, that to reverse the hollowing out of America, it means that many of the companies that have benefited from this policy are not going to have this policy to benefit from. So you have these two huge macro forces. One is deregulation, which is definitely better for smaller businesses and the economy writ large. And two, which is the financialization aspect, which is allowing big companies really cheap access to capitals to automate offshore and do a variety of things that make their profit margins better, which is definitely under threat from this administration because they understand this. I don't have any particular prediction about that. My predictions are because I think, and James, you're going to have to do this too, is 2025 will be a better year for Bitcoin than 2024. Well, I know what that means. That means that because 2024, Bitcoin went from 42,000 to 95 or whatever it's going to end the year at. So I think that Bitcoin will see a price over 250,000 during 2025. Yes, I believe that. Okay. So we'll see if I'm right or wrong. I could easily be wrong, but I think it's supply and demand.
Sounds like we got a third stake bet, but I want to go back to James before we make the stake bet because I know Mike's going to definitely want to take the other one. But James, so obviously we're sort of talking about the Department of Government Efficiency and how much they can really do if we're actually in a debt spiral. I think that was what you were kind of leaning to.
And the point that I was going to make that Dave, emphasized is that we have to, what I think this administration is going to do is they're going to focus on deregulation. And especially in, especially for small businesses, the red tape is onerous for small businesses, and to, remove a lot of that red tape will just make these businesses more profitable, and that will add to GDP. And, you reduce government spending on administration and red tape. It'll increase private innovation and private, profits. And so private profitability also in the energy sector. And the more you can deregulate and expand the energy sector, allow for refineries to be built, allow for pipelines to be built, allow for lower cost energy, that will bring down inflation and it will create more profitability for companies. I mean, the number one input for inflation is energy. The energy cost, and it's just what the cost to run the machines, to run your manufacturing facilities, to transport the goods. Half the stuff we wear and use is somehow made out of crude oil. So it's important, and I think this administration is going to focus on that. They're going to focus on the top line. They keep talking about focusing on the bottom line. And how, they're going to bring down expenses, but there's only so much you can do in the structure of what we have in our deficits. And because we have such high mandatory expenses. It's going to be very difficult to cut a lot of that. And so that's exactly what the focus, I think, will be, which means that I agree. I think that this market, Mike's been saying this for a long time. You could see it. You look at the charts. This is just seems insane that the markets just keep marching to higher and higher highs. It's just, when does it end? Well, it should have a pullback. I agree. I'm not sure when or how, but it should have a pullback. And, but remember that this administration does not want to pull back. The Trump administration wants to come in and have the markets off to the races. That doesn't mean they can't, they can stop it.
I just wonder if they can do that for 4 more years, right? I mean, as I keep saying, I've been impressed always with how many levers and tricks they have to pull and perform. But 4 years of pretending this isn't happening, that's only printing excessively. It solves that. There's no other way.
Here's the problem with, go ahead, Dave.
No, I'll tee you up here though, Mike, is that, the markets, if you look at the expansion of the money supply and you look at liquidity, the markets have gotten ahead of themselves. That's just reality. And Bitcoin has, it's gotten ahead of it, if Bitcoin really does hug that, the liquidity indicators and a 3-month lag, it looks like it's got a little sell-off period here. Now, that said, there is massive amount of there are some great developments in Bitcoin that are fundamentally change Bitcoin, and those things have to do with the ETFs, the ETF options, the FASB ruling, the possibility of this becoming a reserve asset for the United States. Like, those are really big deals, and those are fundamental changes. It's being priced in. I think that the market got ahead of itself. The Bitcoin got ahead of itself, charging up to 108,000. And then, in last week, just in a few words, Powell popped that bubble. I mean, he literally just said, nope, got ahead of itself. And, and I can show you just in a simple chart here. This is really easy to see. You can pull this up. This is what happened. Everybody's wondering what happened to Bitcoin last week. It's simple. And you see this, Scott?
Yeah, bringing it up right now.
It's pretty simple what happened, So, whoops, let me defer this out of there. So it's pretty simple. You can just see where the rates were in this light blue line. This is the Fed dot plot where the Fed officials put down where they expect rates to go. That's the light blue line. And then after the meeting, this is where it shifted up to. That's it right there. That's what happened last week. And so all the rates pushed up. The 10-year is now, the 10-year has moved up a full percent at the same time that the Fed has lowered rates by a full percent in the last few months. That's what's happened. And so we have, structurally, bond investors are expecting more inflation. And so something that's really interesting that happened last week, that Powell has been pounding the table for years now, that the Fed is data dependent. The Fed is data dependent. The Fed is data dependent. And that's why their big excuse is, I know the data is lagging, but we're data dependent. So we've got to focus on the data. Even though it's lagging, we're going to focus on the data. And then all of a sudden last week they said, oh, we're going to focus on the expectation that there's going to be inflation from tariffs. Like, out of the blue, just like, now we're going to focus on, well, there's probably going to be tariffs from Trump's administration, and that's inflationary. So that's what we're going to focus on now. It was kind of bizarre to me. It does make intellectual sense. However, we don't know what the tariffs are going to be, and we don't know how much they're just going to be used as a threat. I've talked about this a number of times on this show before. Trump loves to wield a big sword, and tariffs are a big sword. And how much he uses them is up for question. How much he uses them as a threat is not up for question. He's going to use them as a threat. There's no doubt about it. But how inflationary they're actually going to be, that's difficult to say. So I'm not sure. But now the markets has tilted toward that way, and that kind of tees you up, Mike, being the ex-bond trader, that this is kind of where we're at. And I think that I think Powell's kind of lost the bond market, especially on the long end.
I mean, I just have to interject one thing. I mean, yes, on a relative basis, what you say is true. But, I'm old enough, and God knows Mike's old enough to remember that an uninverted normal yield curve has more than 20 basis points of upward tilt over from 2 to 10 or 1 month to 10. And that's what we got right now. Right now, the 10 years at 4.5, the 2 years at 4.3, 1 month is at 4.3. So you got 20 basis points of upward tilt. We saw years, decades actually, with multiple percent of upward tilt between the shorter and
But what the market is telling you is that structurally rates are going to be higher. Structurally, for that means that we're zero interest rate, policy is gone. That's what the rates are telling you right now.
Which rates are telling you that?
The 10-year.
Well, but we had just think about it. Before we went into the idiocy of complete zero interest rates, what was the average? And we'll let Mike talk because he has all the data right in front of him on the terminal. What was the 10-year back in the 90s under the Clinton presidency, and what were short rates, and how did it migrate? And I think when you look at that, it gives you some interesting perspective. What say you?
Go ahead, Mike. Bring it up.
Well, let's start with as something I wanted to speak about was we've had some great indications of what to expect this year for next year. Again, I'm making my predictions next year. And the number one market I've been wrong on is James, and most of you have been right on, is that I still think the next big trade is U.S. Treasury long bonds. Obviously I've traded them forever. I used to have hair. And the key thing I like to point out is we got a good test this year. We had TLT rose 15% from April to that August peak. Remember, we were all in August when James was buying Bitcoin at 50 and you were all over it, Scott and Dave. But TLT rose 15%. To me, that's the next big trade when we get that normal reversion into U.S. equities. Now, maybe it's a trade or maybe it's a long-term position, but we're just so undervalued now versus gold, versus the world, versus history, even versus our debt to GDP. It's just the key things that I want to point out. An article that recently came on the Bloomberg was America needs to break its debt addiction by my colleagues Burgess and Crook. And here's a key quote from that. The U.S. collects 25.2% of GDP as tax revenue, or $7.4 trillion in 2003. The average among the OECD countries is 33.9%. So if the U.S. matched that average, it would result in 10 trillion of tax revenue if it were to do that. It's not going to do that, but that just shows how much we could cover our debt if we want to. It's not going to happen with.
But how much would that impact the top line?
So, well, that's the bottom line. That's my point. Is we've elevated risk assets so much, and this massive deficit spending. And my only question I look at when markets is at 1927, 28, and 29. And I refer back to Roger Babson, who spoke about it completely. And I want to be people very completely wary of the Irving Fishers out there looking for a permanently high plateau. This is what I'm looking for next year. And you see it in Bitcoin. Is that Bitcoin to gold ratio? It's showing you there's issues. You see it in the rest of the world. But this is also epic historic what's happening. And another prediction, fully expect the lessons that Trump learned from Trump administration 1.0 is he did raise tariffs on China. A lot of them are still kept in there, and they still are showing major pushback. They're showing they're telling the world we are a bad trading partner because they know they're the best trading partner in the world is the U.S., yet they're still pushing back on trying to limit rare earth metals. Like, okay, now we get exactly where your tilt is. You could at least pull back and say, yeah, we'll buy some of your stuff because you're the best place in the world. But they're not doing that. So there will be tariffs across the board. So here's the numbers on the tariff. First of all, we have a trade deficit around $1 trillion, around a little bit less. If you just have 20% across the board tariffs on that's $200 billion. It's a rounding error compared to the next 10% correction in the stock market, which will happen this year. McGlone's prediction. That's $6 trillion. That's deflation. And that's what we're way overdue for. And I'll mention two books. One of the books we all appreciate is The Price of Tomorrow by Jeff Booth. big Bitcoiner, pointed out how the benefits of Bitcoin, pointed out how China's collapsing. He did this years ago. He was spot on. Ray Dalio got it wrong. Ray Dalio flipped over. So I've been going with Jeff Well. Another one is The Price of Time by Edward Chancellor, pointing out how the whole history of rapidly advancing economies and markets that move up on massive liquidity always go down. Now, the rest of the world's doing that. Look what's happening in Germany, Canada, Brazil. France? We can just keep mentioning them. Certainly China. The U.S. is the lone star. And that's what I think is going to tilt over next year, partly because here's the human nature. We completely have priced for the U.S. It's the best country in the world, obviously, but it's so expensive. We've got this wonderful president that's going to save everything, completely priced it in. And now here's the next big trade. So this is where we're tilting now. And things like deficits won't matter when people are looking at the stock markets we all know this. We've been through these cycles. There's periods where people give up, and we haven't had that in a long time where people say, okay, I'm in it for the long haul, but yeah, it's starting to hurt my portfolio and I can't spend anymore because my wife wants to buy this, and that, and my 401k has dropped 10% or 20%. This is going to happen. It always does. And I think it's going to happen maybe in Q1, but it's going to happen next year. So what are the signals? Bitcoin.
So here's the question for you. Let me ask you a couple hypotheticals, because I agree that the debt to GDP, that's a big deal, but that the stock market capitalization of GDP is at an absurd level and valuation. And yes, economists are predicting 14-15% earnings growth next year, which sounds great. But then you look at that earnings growth and you look at what the PEs that behind it are, and effectively the stock market is priced for it to exceed on the upside on what is already a very, very rosy forecast. So I got that. And I don't dispute that it's gotten to a level of absurdity that the market hasn't corrected at all and flushed any of the excesses out. That's all. I agree with that as well. But what happens if instead of a crash, you get a couple of months of grinding lower and 10% or even 15% spread out over a few months is not a crash. Correlations don't necessarily go anywhere. I mean, we saw, let's say you get in the S&P, what we saw in Bitcoin from its 70,000, where it literally dropped from 70,000 to below 50. And nobody called it a crash. It was a grinding, and it was going up and down during that period of time. What if we get a period in time in the growth stocks in the stock market that look more like that? In that scenario, correlations don't go to 1 because the moves aren't big enough most of the time. Then what happens? Where does money flow, and what do people do? Your bet, Bitcoin. Yeah, your bet is it goes into the long bond. That's your TLT trade. James, I don't know about James. I won't speak for you. My bet is the money goes into Bitcoin, not speculative crypto, but Bitcoin, or at least some of it does, and some of it into gold as well. I am bullish on gold also. That's the funny part about our bet is I think that Bitcoin will outperform, sure, but I will be very surprised if we don't see $3,000 gold in 2025. Very. And so, to me, that's I just want to understand and frame the difference. That gets us a lot closer than people think we are.
Okay, well, it's no fun to be close, Dave. We got to disagree. It's more fun for the audience, and it also provides value. So let's make the risk of making predictions for 2025. Gold, yeah, 3,000 matter time. McGlone's been early, way wrong, if you could say, but I've been calling for this for years. What gets the gold to 4,000? We can talk about that. That's just a normal bear market in the U.S. stock market, which goes down 20%, stays down. That's a problem. I'm not predicting it. I hope it doesn't happen. But crude oil, James, you mentioned crude oil. It's going to 40. McGlone's been early. Some people can say wrong, but what's the number one thing people miss about crude oil? It's the elasticity of supply. We're in this period now. We have so much rapidly advancing technology. I mean, why can you and I trade Bitcoin on our phones now? Because we couldn't do that in the past. Why is McGlone's EV 10 years old? People miss the fact of that elasticity. The key thing you learn in commodities is markets don't go up because they go up like in equities. They go down because they went up. So crude oil's going to 40. That means the average price of gasoline in this country, which is around $3 a gallon, is going to 2. That's not good for, it's a bad sign for economy, but it's really good for deflation. Diesel in this country is running around $3.50. It goes to $2.50. It helps the grease of the global economy. The problem is diesel demand on a global basis in the U.S., in Canada, in Europe, in China, in India is all declining. That's the deflationary forces I'm worried about. It's the grease of the global economy. Let's look at copper. The Dr. Copper is the indicate. It's typically, if you overlay copper right now, it's like 4.1 with that US 10-year note yield. They've been 1-to-1 for like decades. Right now, copper says the 10-year note yield at 450 is really high. I think copper is going to 3. Number one, it's been doing that for like 12 years. It made a new high around 550 this year, and it's probably going to go back down. Yes, I could be wrong. What's the number one thing to make me wrong on that? China has to really come out of this massive stimulus and have some demand pull. But its customers are pushing back partly because it's supporting the war in its neighbor's best country. To me, that's where we're going in terms of commodities. And I agree with you, Dave. That would be wonderful. It'd be a great chance, I think, for people to reassess. This is right now, we're in one of those animal spirits bull market, and everybody's making money. It's great. And everybody's wives can spend more money because all the assets are appreciating. Those of us who have wives who spend all of their money, we get that. But, and I knew I'd get a lot, but it's all the way it is. It's like, yeah, I'm very parsimonious, but yeah, I'm married. Well, I got a lot of dependents. We all get that. So to me, that's what's going to happen. That would be ideal. If we just get some normalization. Trump comes in, we all realize, okay, we're overpriced. We got this great future to look forward to. We consolidate for a year or maybe less. Bitcoin shows outperformance. So here's what I'll end with. I've been saying for years, I've been way wrong on the stock market, but I've been expecting Bitcoin to outperform. So I've been saying for years, it's been gold, Bitcoin, and long bonds. Definitely long on the long bonds. Bitcoin, I think it's way overdone. It should be lightened up. And gold's still doing well. So to me, I think at some point next year, Bitcoin's going to give us a chance to get it a little cheaper, get in cheaper, and it'll go back up. Not the rest of the cryptos. I mean, Ethereum and those 2.5 million cryptos were unlimited supply. Just be careful there. Trade them, sure. But to me, that's where we're going for next year. Gold's still appreciating, but I'm really worried what gets gold to 4,000. That is just what used to happen. A normal correction, stock market at 2.2 debt to GDP, which is now actually 2.1, comes down to maybe 1.5. That gold takes off. I mean, because that's deflationary. That's what I'm worried about the next big trade. But in terms of commodities, what's the main problem with commodities? I'll end with this: is they went up a lot. They had a great incentive. They tweaked those lessons of Jeff Booth. They tweaked those lessons of rapidly advancing technology, and the lessons you learn in something that you can bring on supply. Stick with the technology, obviously stocks, but not what they're creating. We can create more petroleum and more food every day, particularly in this country, without too much regulation.
I'm going to go to first principles, which is the stock market and all assets are absolutely tied to the money supply. And so that's where we are. We were overcooked in the markets versus the money supply right now. So we have two choices. We could have just mean reversion of the stock market back to the money supply, or we could start seeing expansion of the money supply globally again. And so one of the things that we're not talking about that we should talk about is, first of all, the U.S. government's going to issue another $181 billion of debt in the next week or so, right? Before year end. That's what they're slated for. That's number one. Number two, Janet Yellen has run the playbook of let's keep this thing going. Let's keep this charade going. Let's just issue as many short-term T-bills as we can to keep this whole, this charade and musical chairs going. Well, that's going to end. That's going to end because we have $98 billion left in the reverse repo. That's it. It's all the way down. It's down from the high of somewhere around 2.5 trillion, and now it's $98 billion left. That's what's in the money markets. Okay. And we heard Powell talk about this back earlier in 2024. He was asked explicitly, when do they stop QT and when do they start QE? And he said they don't start getting nervous until and I can't remember if it was in one of the press conferences, but I recall him saying that they don't start getting nervous until that the bank deposits are somewhere around 10% of GDP. So GDP is 29 trillion. So bank deposits right now are about 3.2 trillion, and you've got nothing left in the reverse repo. So that's when they start getting nervous. And we all know what happens if the bond market locks up. We saw it happen in September 2019. And what did the Fed do? They rushed out and printed money. They started printing money before COVID. This is what people forget. We were printing money before COVID, before the lockdowns. The fall before the lockdowns, we were printing money. So the question is, how quickly do they stop QT? This is another part of the pivot. So we've had now we're on pause, right? So you can either raise rates or lower rates at the Fed. You can either splash, you can either inject the markets with capital, which is QE, or you can remove capital from the markets, which is QT. Right now, they're removing $25 billion a month. It's nothing. When they stop that, that's another indicator that's then a full pause, right? So right now we're still tightening a little bit. Keep the rates where they are, and you're pulling $25 billion of capital out of the markets monthly. When you go to full pause or you reverse that, that's a huge indicator. So the question here, Mike, is, and here's my base case, is we either have some sort of credit lockup where the Fed rushes in and starts printing again, and you have V drawdown and recovery, or they just avoid it altogether and they just start printing money before it happens because of worrying about having another repo market lockup like they did back in 2019. Of course, the repo market is open all the time now, so they have structurally they have in place some kind of guardrails to prevent that from happening. But that's the U.S. money supply. So that's kind of where we're at. Do we have the money supply globally start to expand where that mean reversion is the money supply reverts upwards, not the markets reverting downwards? And that's the question. Well, I would think that with this administration, they're going to do everything they can to splash liquidity into the markets to avoid a market drawdown, as opposed to just naturally having a market drawdown, which you look at the markets. I agree with you, Mike. They're overcooked. They're overdone. The question is, are we going to expand the money supply first, or are we going to have a V drawdown, or are we just going to grind lower like Dave is saying? And that's the big question for 2025.
I want to be clear what my most bullish scenario is, and this is going to be kind of interesting for viewers. My most bullish scenario is, from a Bitcoin point of view, is Bitcoin kind of, and you see it today, the stock market is mensa, kind of mixed, some down, some up, whatever. And Bitcoin is lagging, since we've started this, it's down, $1,500, something like that, below 94. My most bullish scenario is Bitcoin, where it's very clear that what's happening is there's speculation building on the short side. Because you can see it in the funding rates. It's very, very clear. They're the lowest I've seen them for a while. And in fact, on the USDT, the US dollar denominated contracts, as opposed to the token, the coin ones, you actually see negative rates all across the board. So it's interesting. My most bullish scenario is through the end of the year for another 2 or 3 weeks of this. And then some catalyst, and then now you have a coiled spring. And it wouldn't surprise me to see that because, in particular, new entrants rarely deploy new capital right at the end of the year. So we're in a very tricky period where a lot of what's been holding up the Bitcoin market have been new entrants from the institutional side. Now, I do think there are people who will make their allocations before year end for a variety of tax reasons, but still, I think that January is generally, I am more bullish on a January rally than a Santa Claus rally. I would be kind of surprised to see anything major, barring a major announcement in the Bitcoin market, major catalyst upward, but who knows?
Like this guy?
Well, I mean, the problem is that guy is, if you look at his chart, he's not an idiot. He's put really smart people on his board of directors. Brian Brooks and his board of directors just got announced this weekend. Right. When you look at those, he has this great chart with the bubbles. And when you see too much at tops, I think he's going to back off for a bit. I really do. I mean, maybe not as it falls, but certainly if it rises, I think he backs off and lets it go.
He said in an interview last week, Michael said that he's going to start using debt more than the ATM coming into the next year. So
well, we
next
know
year,
that. Yeah. That'll help the ratio. But I mean, look, the point is to the extent you believe what he believes and what I believe, then accumulating fairly passively and letting the market sell to him is a smart strategy. Chasing the next time that there's a major event up, that's probably not going to happen. So I don't think MicroStrategy or any of the companies that we've talked about are the catalysts for a move higher. The catalysts for a move higher are new people, or new sovereigns and people allocating. And probably the most underestimated effect, which is the back half of 2025, is that the entire brokerage community, which today is not just can't offer Bitcoin trading services to their clients, it has right now today a strong counter incentive to actually push away from them. And that's going to change. You can take that one to the bank. That one of the first things that's going to happen with a new SEC oversight is FINRA is going to stop denying broker dealers from their applications to offer these services. That it would make the change complete. No longer is it, are we looking at things like, oh, this is a big deal that Yahoo Finance added Bitcoin to their banner on their app. I mean, although that has happened, I think that you will see the full integration of Bitcoin as being able to be offered by broker dealers. And that is something that people aren't talking about. But effectively, that ends the restriction side. And yeah, there are already interesting things going on there. I mean, even in Charles Schwab, which offers everything, and it's very, it's not a problem. You still have to click extra official, things to say, okay, I recognize cryptocurrency is volatile. That's fine. Brokers have no problem with that. But I think that people need to understand that from the supply-demand dynamic, there's a lot that's likely to change. And, I'll continue to come back to the demonetization of gold. I don't believe it works the same way gold did to silver, although it's similar. Gold definitely did demonetize silver in a sense. Silver still does move with inflation, does move, and is used as a monetary metal by some, particularly Chinese. But the truth is, it's just too hard. It's just, it's just too heavy. It weighs too much per unit of actual value. So, we'll see how all that works out. But I think that's a big thing. Now, the thing you said before, James, that's really important in terms of global liquidity is really what we should be talking about. Does the Fed do, or is this going to be kind of forced to? And the real question that we're going to learn in the next year is how much political influence affects the Fed. And we're not talking about it, but we kind of know that's a big deal. What do you think?
I think that Trump is he's demonstrated before. He belittles people. He berates them. And I don't know if Powell has said he's not going to quit. He's not going to resign. But if he doesn't do what Trump wants, Trump is going to make life difficult for him. That I would expect, and I would expect Trump to be demanding rates lower and more liquidity because he wants the stock market up and he wants that top line up. He knows that our nation is completely financialized and expansion of money supply makes it easier. That's my guess.
Mike, you're muted. See if I can unmute him.
Mike, you're unmute and then you get the last word. We're pretty close to it.
I don't know if I'm worthy of that.
You are.
All right, you should be able to hear me now. Can I just show a few screens? You see the one that says Michael Saylor says Warren Buffett is destroying Berkshire Capital? Can I share that screen? Yeah, so I got to show that. So that's one thing I love about what I do. I mean, I am an ex-trader. You guys, first of all, anybody in this podcast and video who listens, and certainly you who do it, I completely respect you. I'm an ex-doer. I say it better, I do it. But this is one of the biggest double dog dares in history. I cannot wait. I hope I live long enough to write about this. I just hope it doesn't mark a big peak, but you don't double dog dare markets. And this is the biggest one. This is from November 22. I mean, seriously, this is just like, you just double dog dare markets. It's a lesson I learned in trading pits, have made the mistake myself. But this one thing I want to talk about debt. If you do look at the total treasury debt divided by stock market cap, it's like 60% completely heading lower. So it's all that matters is you got to keep that stock market cap higher. It's the highest. It's 97th, 96th percentile expensive in history. good luck. We all know that regardless who's coming in president, I just like, there's a trade here, maybe a good long-term trade. Like I said, it's in 1927, 28 or 29. I see it happen. Key thing also I see about it is this as gold to S&P cross. It's just so buried. I mean, it's a one market. You got to have that go lower. I just need that to go lower. Yet I'm afraid it's going to go higher. And here's the chart that it looks like a peak that I'm so not happy with, but I'm worried that this is Bitcoin divided by gold. That looks like a pretty good high. Looks like it easily drop down and mean reverse. So to me, I'm not worried the last word. I'm just pointing out it's looking at the beginning of this year. Thing I got way wrong. I didn't think we'd get a 30% increase in the S&P 500. We did get that massive move in Bitcoin. And my thought is everything's so expensive. You can sometimes, it's a lesson I learned in the trading puts sometimes. And when you get a trade on it, getting 70% of that trade is wonderful. Getting the wings, the kurtosis of the normal distribution, as Dave and James are over. You got to be careful trying to pick peaks and pick bottoms. We got a massive, good, rapidly advancing risk asset trade for 2024. To me, 2025 is going to be about what this chart's already showing is.
Put that chart
a little
back
reversion.
up. Can you put that chart back up? The gold one. Yeah, that one.
Yeah,
now, if no, the gold, the
one
gold
you had.
one.
Yeah.
If you, the gold, the one you just had up a second ago.
Keep going. I got it here anyways. Yeah. Bitcoin to gold ratio.
Right.
Yeah.
So if you look at that and you say, what happens if, we know that double top in the middle of that screen was the market getting, completely ahead of itself and then getting absolute bitch slapped by what happened with GBTC, which took down 3 arrows, and Terra Luna, which took down others, and then FTX. We all understand what happened. Now ask yourself the question. What does that trend line look like if you take those peaks out? And it looks like one of the most bullish charts you will ever see. And ask yourself the question, could history repeat? Could we get to the point where we say, you know what, Bitcoin should be gold? And then
put that on a log. Yeah, because it's demonetizing gold. It is in real time. Now, maybe it's gone ahead of itself in the short term, but it is demonetizing gold.
I look at this chart and and this is because it's like a Rorschach test, personality-wise. I look at that chart, and this makes me crazy bullish, not the other way around, Bitcoin versus gold. It's literally funny. I mean, when we did this, when we had our bet toward the beginning of the year, and we were sitting at like 22, 23, or whatever the hell it was, 26, I don't remember, but it was somewhere in that range. It looks like a very, very strong, and if you look at the S&P circa 2013, 2014, it sort of looked, or 2015, after there was a little bit of a blow-off sell, it looked the same or very similar. And we know what's happened in the last 9 years. And now I think Bitcoin this stuff's going to happen quicker, and I think that it's a little bit more cyclical and there's going to be more volatility. But it's interesting because I think that we're talking about an asset that's evolving as opposed to an asset. Whereas with oil, I think you're right. And maybe, in terms of inflation, maybe it doesn't go to 40, but 50. 60 to account for the more dollars and the whatever. I mean, yeah, that doesn't seem crazy at all because you're right. The electricity supply is huge, and we keep our technology to extract oil has gotten so much better. So you're absolutely right about that. But Bitcoin's not like that, and that's really kind of, it crystallizes the difference in you and I.
Well, the best part is that we'll be here to find out.
Yeah. It'll be good.
That's right.
Going into 2025, I hope that once Dave is running the country, he's still talking every once in a while to, say hi to the little people.
I don't have these delusions of grandeur.
You never know. Anything can happen. I believe in you. Guys, that's all we got. Like I said, we will be off next week coming into the new year. So assuming we'll be back the first week of January. Thanks once again for an amazing year of Macro Monday. Always showing up the incredible commentary. And I can't wait to see what kind of wild bets we come up with for stake in 2025. That's all we got.
You need to get to Miami. I'm still
I'm going to try to come down in January in general for a few things. So we'll make it happen then.
Okay, cool.
Good time to come to Miami.
All right, guys. Thank you so much.
All right, fellas.
Cheers.
Let's go.